ISMs, the global picture is not as rosy as you would expect it to be, given how much Fed intervention we've had. Now we're talking about negative interest rates in Europe and Japan, et cetera. That's not good for risk assets at the end of the day. So my point around all of this, from the listeners at home, right, is the wealth effect really is driven by what we've seen with monetary policy. If the wealth effect starts to give up the ghost, which is kind of what's going on here, right? What's next? What's really happening now is that there's this pivot going on between growth, everything, momentum that's been working. No stocks got to 30 times earnings.
Right.
That's not working anymore. You've seen them really reverse in January and February. Where does that money go? I think some of it goes to the sidelines, which just probably makes some sense. And the rest is going to pivot toward things that are more value-driven, right?
So I wonder, Mark, in this environment, so especially since you guys deal and historically have dealt a lot in some of the distressed high-yield parts of the market, loans, bonds, you name it, there's been a lot of carnage.
Right.
What are you doing right now? I mean, where do you think that people should put money to work?
So we're barbelling it a bit. So anything that gets stressed in here gets overshot. You saw the financials last week get hit, right? And they really overshot to that graph we were just looking at. That's happening in credit names when they get stressed. So something that normally would trade to an 8 or 9%, it's going to 15. We're stepping in and buying that. We love that kind of value. On the other hand, on the barbell, some of this higher quality stuff like bank loans, right, are trading to 7, 8%. That's floating rate secured. The economy is doing well, Bill. So we like that. We think that that's good value. And I think this whole pivot from growth to value is going to be something that we keep talking about on the show.
You don't get much more distressed, though, than energy.
That's right.
You ready to buy anything there?
I think the energy sector has some buys in it, but the one thing that I think that I've been honest about is that predicting the price of oil from here is really going to be very difficult. Because we're in a different dynamic for global growth.
So you won't buy oil stocks until you think oil prices have bottomed.
I'd like to see them stabilize. I'd like to see them put in a good bottom. We might have put a bottom in last week or the week before. If that happens and we stay in this sort of zip code, I think there will be some nice value, especially in the credit side, because some of that stuff's really been beaten up. But again, it's going to be something that I want to wait and see happen before we step in a lot.
For a while, and so that dislocation and then that coming back to where the credit market is telling you things are going is certainly something that makes a lot of sense. The question, I think, really, Joe, is across all of this is whether we're heading into a recession. Is the stock market telling us a signal that we're going into recession? I really don't think stocks are. I think stocks are looking at a profit recession. And you're seeing it today in a lot of this reporting we've had in the last couple of weeks. A lot of companies are struggling with a stronger dollar. The stronger dollar is creating a profits recession for a lot of companies. And those big winners, these growth stocks that have been driving the stock market, are coming off. Amazon's another great example of that. And I think investors are trying to grapple with that. How do you pivot an entire asset allocation away from growth, which has been working, and if it's not going to work, where do you go? You know, you got to go into value somewhere, and that's finding value is interesting. And I think as we saw this morning with Kuroda shocking the markets in Japan by going negative with rates, you know, all these things point a little bit to what I do, which is credit, right? Credit is a market that, in general, will work in a value time, right? Because you're going to go back to, there's not going to be much growth. We got to search for yield. Where are you going to go get that? Now, it's early. Right? We have to be a little cautious, a little defensive. I'm not saying load the boat.
So what kind of stuff are you looking for then?
Like double Bs. Double Bs look good, even in a.
But just broadly, not even by industry?
Oh no, you pick your spots. This is a stock picker's market. It's always been. It always will be. I mean, not every company is gonna win and lose, but there are much more winners and then losers when the market is this cheap.
That's why I started with you know a lot about credit. So you never did answer about what is it that you're seeing in the credit market to account for what basically it looks like it passes to the equity markets. It looks like it starts in credit markets with junk and with oil-related junk or wherever. There could be 400 of these companies go bankrupt, right? That shouldn't be a problem for the rest of the market unless you have to sell something to cover your losses there. Well, is that what we're seeing?
Well, there's in junk, right? We have a liquidity premium that's building rapidly, and it's massive. So, and you need it because the market is not as liquid as it used to be. And when that pushes up the cost of capital across credit, it's got to be reflected somewhere else in risk assets. It's coming into earnings, but earnings in the PE and the higher cost of capital is also being reflected in the fact that earnings are challenged with a stronger dollar.
It's nerve-wracking. Kate, can it be contained in that sector? I guess that's the question. And how much of it is the change in direction for our central bank here versus everybody else, and how much of it is related to that? I mean, I'm trying to figure out the real cause of all this angst that made it the worst January that I can remember.
Well, I think it's actually three things. It's the worries about slower growth, which is tying into the credit conditions that we just heard about, because it's slower growth as well as low oil prices, which is the second factor that are leading to those higher spreads on junk. And that does translate into worries about earnings for companies, but more so in particular sectors, not across the board. I would say the lower oil prices not only lead to worries about some of the oil companies struggling, but are actually helping earnings in non-energy companies, ones that use energy. It's part of the lower costs, and it's helping them beat on the earnings side, even though their revenues are weak. So the third piece of that global angst that you were talking about that's led to the worst January is, of course, central banks. And do they have enough ammunition to continue to keep helping markets and economic growth in a world where growth is clearly slowing down? We think the answer is yes, but I think the angst came from those three sources, and it's not just credit. Credit is sort of a leading indicator, and it frequently does lead what happens in the equity market.
What you see going on in the markets right now?
Well, there's a lot going on, obviously.
Yeah.
But if we kind of cut through things, I'm always thinking signal and noise. What's the big signal versus the noise? And there's a lot of noise. It's a very noisy last couple of weeks. A lot of signals, too. But the big thing I'm looking at is the real economy versus the markets. The markets are telling a whole different story than I think what's really happening with the economy. If you look at the Goldman Sachs Financial Conditions Index, and you add in the positive effects of oil, you see this giant divergence between Main Street and Wall Street. And certainly things are getting tighter on Wall Street, but Main Street is seeing this wonderful economy. I was talking to a guy this weekend, really smart, small business owner up in New Jersey. He said he's saving $100,000 a year, which is meaningful to him, on lower gas.
So when you hear Carl Icahn say, quote, the high yield market is just a keg of dynamite that sooner or later will blow up, and the catalyst for a lot of this has been the weakness in the energy space, what's your response?
Signal or noise?
Well, I think it's fairly inflammatory. I'm guessing he's short. Because, I mean, what sparked this story on the Third Avenue point, right? This fund has about 5% of normal high yield in it. The rest is distress in special situations, and it's in a daily liquidity fund. So obviously they haven't measured the liquidity properly. But if we, go ahead.
But let me just throw in there. I mean, it all comes together right now, as you're talking about. I mean, with the Fed raising rates, that won't help those guys, and the energy price going lower, that doesn't help those guys.
Exactly.
Are we at the beginning of a new phase of defaults and major stress in the high yield markets?
That's a great question, and I think that certainly in parts of the market, right, the energy space, materials and mining, we see these stories. They're happening already. It's been priced in. These bonds trade very, very low, right? But the comment about the whole broader high yield market is just not true. If you look at the actual valuation in the marketplace, if you look at maturity walls, if you look at interest coverage, the market's actually fairly healthy.
So would you be a buyer of this market right now?
Well, I think you should. What is really going on? This is not just about energy, to your point. It's a great question, right? This is about a broader market. And what is it doing? What is the high yield market really doing right now? It's pricing on a much wider liquidity risk, a much higher liquidity risk. And that is coming through the market, sure. That is actually what's going on. But there are parts of the market that are very high quality. Take bank loans. Now, bank loans are below investment grade, but they're floating rate. You're secured. You don't have a maturity wall, right? You only have 1/3 the energy exposure that high yield has. Guess where that's trading? Over 7%.
Wow.
So default costs historically over cycles is somewhere around 100 basis points. That means you're getting paid 6% for volatility and liquidity risk in here. And I think those are good buys.
Is that how you would? Is that sort of how you would approach assets right now, or would you look at some of the real beaten down parts of the energy and the junk bond space and say, hey, I'm going to ride this out and see value there?
I think it's a bit of both. I'm kind of bearish still on the energy space, so we're kind of not playing that yet. But there are certainly a lot of parts of the distress space that are getting pushed down by some of these guys that are certainly dislocated. But there's higher quality parts that I'm watching too. But the bottom line, I think, as traders and as investors, these are the great opportunities, but you got to be patient, right? You want to be leaking money into this market over time. Calling the bottom when you have a liquidity dislocation, as we all know, is a very difficult thing to do.
Right.
But usually this is where the smart money makes most of its money.
Very quickly, we were talking during the break, the transports are now down 20% from their peak of last year at a time, and puts them in bear market territory, at a time when energy is now at its lowest point in 7 years. Something is amiss here.
Yeah, and to your point, I think the transports really are maybe something to watch, to keep a close eye on here as a signal. I've been fairly bearish, or Highland's been fairly bearish on the stock market for a while because we're in the credit markets. We see what's been happening. This is finally starting to take hold across the equity markets. It feels a little early to me, though, right? So I think we should watch that. I do believe that the market was building a top. It didn't make any sense to me what happened with the stock market after the Fed didn't lift rates in September.
Right.
I'm glad to see them going this week, which is, I think, actually a good thing. But we'll see where next year is. I don't think we're going to see much return. And so my call really is to get out of the beta and try to find things where you're getting long volatility, right? Picking up things that are oversold and then getting involved in more trading type of strategies.